Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're exploring an incredibly important topic that's fundamental to trading success: mastering trading psychology. Whether you're a seasoned investor or just starting, understanding how your emotions influence your decisions is crucial to becoming consistently profitable. Today, we'll specifically dive into overcoming three dominant emotional traps: fear, greed, and the dreaded FOMO. Fear of missing out. Trading isn't just about understanding market trends, technical indicators, or economic reports. It's equally about managing your mindset. Many traders overlook the emotional side of trading, focusing solely on strategy, only to realize later that their emotional responses sabotage their results. Emotional trading often leads to irrational decisions, increased stress, and unnecessary losses. In this episode, we're going to unpack these psychological challenges and give you practical, actionable strategies to master your trading emotions. Let's start by defining trading psychology clearly. Simply put, trading psychology refers to the mental and emotional state traders experience when making investment decisions. This includes how you manage feelings of fear, greed, and the infamous fear of missing out, FOMO. Every trader, regardless of experience level, battles these emotions to some degree. Successful traders aren't emotionless. Rather, they've learned to recognize and manage their emotional responses effectively. Fear is perhaps the most common and powerful emotion traders face. It arises from uncertainty, risk, and potential loss. Every trader has experienced it, especially after suffering a losing streak or encountering market volatility. Fear often manifests as hesitation, causing traders to avoid entering trades even when conditions are ideal. Conversely, fear can trigger impulsive exits, closing positions prematurely due to anxiety about potential losses. So, how can you effectively overcome fear in trading? The answer begins with having a clear, well-defined trading plan. A solid plan acts as your emotional anchor, keeping you grounded even when the markets fluctuate unpredictably. Your plan should outline your exact entry and exit criteria, risk management rules, and position sizing guidelines. By clearly defining your trading strategy, you eliminate ambiguity, the breeding ground for fear. Another powerful method to combat fear is the consistent use of stop loss orders. A stop loss order ensures that you automatically exit a losing position at a predetermined price. This simple mechanism drastically reduces fear because you already know your maximum potential loss before entering the trade. Rather than constantly worrying about market moves, you have peace of mind, knowing your downside is limited and controlled. Maintaining a detailed trading journal also significantly helps manage fear. When you experience a losing trade, rather than allowing fear to build, analyze what happened objectively. Writing down what went wrong, what you learned, and how you can improve turns losses into valuable learning experiences. Over time, this habit can greatly reduce fear and build resilience, as you become comfortable knowing setbacks are part of the journey. Greed, on the other hand, is the emotional opposite of fear, but equally damaging. Greed arises from the desire to maximize profits, often at the expense of logic and discipline. When traders become greedy, they might ignore profit targets, hold positions too long, or take unnecessary risks hoping for even larger gains. Unfortunately, greed frequently results in giving back profits or turning winning trades into losing ones. To control greed, always set realistic, achievable profit targets and stick to them. Clearly define these targets before entering a trade and discipline yourself to follow your plan, regardless of how tempting further gains might appear. Another valuable method is to use a well-defined risk-reward ratio for every trade. For instance, aim for trades that offer at least a 1 to 2 risk-reward ratio. This approach not only helps manage greed, but ensures that your overall strategy remains profitable even if you experience occasional losses. It's also wise to regularly take profits. This means scaling out of winning positions rather than holding the entire position, hoping for even larger gains. By locking in partial profits at predetermined intervals, you reduce the temptation of greed and secure steady earnings. This systematic approach helps traders maintain discipline and emotional stability. Now, let's discuss FOMO, the fear of missing out. FOMO arises when traders see others profiting from a trade they haven't entered, prompting impulsive, poorly considered entries. Driven by the desire not to be left behind, traders often jump into positions without proper analysis or adequate risk management, frequently resulting in losses. The most effective defense against FOMO is having and strictly adhering to a detailed trading strategy. When your trading rules clearly define which trades are suitable for you, impulsive, emotion driven trades become easy to dismiss. For example, if your strategy focuses on long term investing based on fundamental analysis, short term market spikes should not tempt you, no matter how exciting they seem. Another tip to avoid FOMO is to limit your exposure to external influences, especially during trading hours. Excessive engagement with social media, trading forums, or news sources showcasing others' big profits can intensify FOMO. Consider setting boundaries around your social media use, particularly during active trading sessions, and remind yourself that other traders' successes don't diminish your opportunities. Leveraging technology like watch lists and price alerts is another excellent way to combat FOMO. Create a curated list of stocks, currencies, or assets aligned with your strategy and set precise alerts based on your entry criteria. Rather than reacting impulsively to market hype, you only act when a genuine opportunity meets your clearly defined conditions. Building a strong mindset also involves recognizing your emotional state during trades. Self awareness is critical. Regularly assess whether you're making decisions based on careful analysis or emotional reactions. If you notice yourself feeling excited, anxious, or frustrated, pause, step back, and reassess your next move rationally. Practicing patience is also essential. Often, the urge to make immediate trades comes from impatience and the false belief that you must always be actively trading. Yet many successful traders spend considerable time waiting for the right setups. Remember, doing nothing can sometimes be the best decision, saving you from losses that come from impulsive trades. Finally, integrating a structured routine into your trading day enhances emotional discipline. Routines provide stability, reduce uncertainty, and help reinforce consistent behavior. Begin your trading session by reviewing your strategy and assessing market conditions methodically. Stick to this routine consistently. It will help you stay focused and minimize emotional distractions. Ultimately, mastering trading psychology, overcoming fear, greed, and FOMO is about developing emotional intelligence, discipline habits, and a strategic approach to trading. By consistently applying these psychological principles, you significantly enhance your trading performance and resilience. For more trading resources, visit crystalballmarkets.com. That's it for today's episode. I'm Sophia, and I encourage you to stay disciplined, keep your emotions in check, and trade wisely. Thanks for joining me today on Financial Market Insights for Traders. Until next time, take care and trade smart.